If I could only teach you one thing about trading, it would not be where to enter. It would not be where to exit. It would not be what setups to look for, or what indicators to trust, or what time of day to trade. It would be how much to risk per trade, because everything else in trading can be average, and you can still survive. Average entries, average exits, average judgment. But if your sizing is wrong, none of it matters. The best entries in the world will not save you if you risk too much per trade. And the worst entries will not kill you if your sizing is small enough. This is the single variable that decides more outcomes in trading than any other. And almost nobody talks about it the way they talk about setups. Today, we're going to fix that. Welcome back. This is episode 18, Archie 3 of the Perp Trading Psychology series. I want to be direct about something before we start. If you've been trading for less than 2 years, position sizing probably feels like a boring topic. The exciting stuff is finding the right pattern. Catching the move? I get it. I felt the same way when I was new. But everyone who has traded for more than a decade will tell you the same thing. The most important professional skill they developed was not chart reading. It was sizing discipline. Because sizing discipline is what kept them in the game long enough for everything else to start mattering. Let's start with the math briefly. Then we'll get into why the math is the easy part. When you risk a fixed percentage of your account per trade, say 1%, something powerful happens. Your downside is bounded. If you lose 10 trades in a row at 1% risk each, your account is down roughly 10%. Painful, but survivable. You still have 90% of your capital. You can come back. If you risk 5% per trade instead, 10 consecutive losses takes you down 40%. Now you're in serious drawdown. Your decision-making is compromised. Recovery is psychologically and mathematically much harder. If you risk 10% per trade, 10 losses takes you down 65%. You're functionally out of the game. This is not opinion. This is arithmetic. And the gap between 1% and 10% risk isn't proportional. It's exponential. A 10x risk amplifies the death spiral probability by far more than 10 times. Most traders intuit this is more aggressive equals more reward. The reality is, more aggressive doesn't get you more reward in expectation. It gets you more variance. And variance in trading is usually fatal before it pays. The neuroscience of why sizing is hard is worth understanding. When you set up your sizing rules at the start of your trading career, you're in a calm, rational state. You probably write something sensible like 1% per trade. The problem is that calm, rational state is not the state you'll be in when you actually execute the trades. The trader on tilt sizes bigger to make money back. The trader on a hot streak sizes bigger because of confidence. The trader watching a setup they love sizes bigger because it feels right. Each of these emotional states overrides the calm, rational rule. And the brain has no built-in defense against this override. Your prefrontal cortex set the rule. Your limbic system breaks the rule. Without external structure, the limbic system wins. This is why every long-term trader builds external structure around sizing. Calculators, pre-trade checklists, hard rules, position size locked into the order before they're allowed to see the chart. The structure isn't because they don't trust math. It's because they don't trust themselves to follow math when emotional. There's a specific pattern that destroys most accounts, the conviction up trade. Every trader knows the feeling. You see a setup. It looks better than usual. The conviction is higher. The risk-reward seems exceptional. You decide to size up just for this one. Because this one is different, you risk 3% instead of 1, or 5% instead of 2. Whatever your normal is, you go above it. Sometimes the trade works, you feel validated. The next time conviction feels high, you size up even more. Then one of these high conviction trades fails. And because you sized up, the failure is disproportionate. A 5% risk that went wrong wipes out the gains from your last 3 normal trades. Sometimes more. The math of conviction sizing is brutal. To break even from a single oversized loss, you need many more wins at normal size. The asymmetry is hidden when you're winning and crushing when you're not. Pros size based on the system, not the trade. Their sizing is roughly constant regardless of how exciting the setup feels. The boring sameness of pro sizing is what makes them pros. Amateur sizing varies with conviction. Pro sizing varies with account state. That single difference, applied over hundreds of trades, is most of the gap between profitable and unprofitable traders. There's another pattern I want to name. The risk of ruin underestimate. When you ask a trader, what's the probability you blow your account this year? Most will say 0 or 1%. They don't see it as a realistic scenario. But mathematically, with their current sizing, the actual probability is often 10 to 30%. The disconnect comes from how the brain processes catastrophic events. We're not good at imagining low, probability high, impact outcomes for our own lives. We see them as things that happen to other people. But the math doesn't care what we feel. If your sizing means a 6 trade losing streak takes you down 60%, and your strategy has a 60% win rate, a 6 loss streak is going to happen. Not maybe, will happen. Sometimes within the first year. The traders who size at 1% or less per trade have a real risk of ruin under 1%. Even with bad strategies, even through bad luck, they survive. The traders who size at 3 to 5% per trade have a real risk of ruin of 10% or more. Over a few years, that 10% compounds into roughly even odds of blowing up. Trading at sizes that give you 10% annual risk of ruin is not aggressive. It's not high conviction. It's mathematically reckless. The only reason people do it is that the math is invisible until it isn't. There's a cultural amplifier on bad sizing. Crypto trading culture, especially around perps, celebrates big position sizes. The viral content is, I went all in on this trade and it printed. The content that doesn't go viral is, I sized at 1% and slowly compounded over 5 years. This creates a calibration problem in newer traders. They watch the viral stories and assume that's how serious traders trade. They feel boring for sizing small. They feel like they're missing out. The viral stories are survivor bias squared. For every trader who went all in and printed, there are 100 who went all in and got liquidated. You don't see those. They don't make content. They quietly close their accounts and move on. If you only consume the survivor stories, your felt sense of what aggressive trading looks like is calibrated to fantasy. Your idea of acceptable risk drifts way above what pros actually take. The fix is actively seek out the survivor bias-free statistics. Look at academic studies of retail futures traders. Look at long-term hedge fund returns. Look at the position sizes of profitable institutional traders. The picture is universally boring. Small risk per trade, modest position sizes, slow compounding. That boring picture is reality. The viral picture is fiction. And aligning your sizing with reality instead of fiction is most of what it takes to survive. There's a leverage angle that matters, specifically on perps. Leverage and position sizing are often confused. They are not the same thing. Leverage is the multiplier on your position. Sizing is how much of your account is actually at risk per trade. You can trade 10x leverage and risk 1% per trade if your stop is tight enough that the position would only lose 1% of the account on hit. You can also trade 2x leverage and risk 20% per trade if your stop is wide enough. What matters is not the leverage number on the trade. It's the dollar amount you'll lose if your stop hits. Most new perp traders set their leverage and forget about it. They never compute the actual risk per trade. They feel, I'm only at 5x, so I'm being conservative. But their actual exposure might be 10% of account per trade because their stops are far from entry. The pros work backward. They start with the dollar amount they're willing to lose on this trade, say 1% of the account. Then they figure out where their stop is. Then they compute position size and leverage from those two inputs. This sounds simple. Almost nobody does it, because doing it requires either pre-trade calculation or a calculator app open every time. Most traders just eyeball it. And eyeballing is the gateway to oversized trades. So how do you actually master position sizing? 3 practical rules. 1. Risk a fixed percentage of your current account per trade, 1% or less for most traders. This is the most important rule in trading. Almost nothing else matters as much as this. If you're not sure where to start at 1%. 0.5% if you're newer than a year. 0.25% if you're newer than 6 months. Most retail traders should never go above 1% risk per trade, ever, regardless of conviction, regardless of streak. 2. Calculate position size before you look at the chart on entry. Decide your risk. Identify your stop level. Compute position size from those 2 inputs. Then enter the trade. If you flip the order, looking at the chart, picking a position size that feels right, then setting a stop. You've already let emotion contaminate the sizing decision. The math has to come first, and it has to come from inputs that aren't your current emotional state. 3. Audit your sizing weekly. Once a week, look at your last 50 trades. Compute the average actual risk per trade, not the planned risk, the actual one, based on where the stop hit or where you closed. If your actual average is higher than your planned average, you have a discipline problem. Probably you've been moving stops or sizing up under pressure. Most traders never run this audit. They believe they're sizing at 1%. The audit reveals they've been averaging 2 or 3. Year after year, without ever noticing. The audit catches what the memory doesn't. There's a flip side worth knowing. When you commit to small, consistent sizing, your trading immediately becomes less exciting. Wins feel smaller. Losses feel smaller. The daily emotional volatility drops dramatically. For new traders, this feels boring. They worry they'll never make real money this way. The math says otherwise. A trader who risks 1% per trade, takes 200 trades per year, and has a small positive expectancy will compound meaningfully over time. Decades-long traders who started this way are wealthier than the all-in cowboys who briefly outperformed them in single seasons. The slow compounding doesn't feel like much in any single year. Across 10 years, it's everything. The fast cowboys feel like they're winning right up until they're not. And then the not winning year erases everything. This is the foundational insight of long-term trading. Small, consistent sizing is mathematically superior to large variable sizing. Not just less stressful, actually better at producing wealth. The traders who internalize this and let it guide their actual behavior become the multi-decade traders. The traders who keep sizing for the dopamine of big wins become the cautionary tales. To summarize today's episode, position sizing is the single most important variable in trading. More than entries, exits, indicators, or setups. The math of small risk per trade makes you robust to bad luck. The math of large risk per trade makes you fragile to it. The brain naturally wants to size up in moments of conviction or emotion. The structure to resist this is external, calculators, pre-trade checklists, hard rules. Without structure, the limbic system wins over the prefrontal cortex. Leverage and position size are different things. Leverage is the multiplier, size is how much you'll actually lose if the stop hits. Compute the latter and let the former fall out of the math. The three rules: fix your risk percentage at 1% or less, calculate position size before looking at the chart, audit your actual sizing weekly to catch drift you didn't notice. Underneath all of this is the same insight. The trader who survives 10 years isn't the one with the best setups. It's the one whose sizing discipline kept the account alive long enough for the setups to start mattering. In the next episode, we're going to talk about what you actually pay attention to day to day in trading. Process versus outcome. Why focusing on your P&L chart will gradually destroy your trading. What pros watch instead. And the daily, weekly, monthly review structure that builds skill instead of just tracking results. If today was about how much to risk per trade, the next one is about how to evaluate yourself across hundreds of trades without losing your mind to the equity curve. Appreciate you all for listening. If this episode found you sizing bigger than you should be, and you know if you are, take the warning seriously. The sizing is the foundation. Get it right or nothing else matters. Subscribe and share with anyone who's risking too much per trade. And I'll see you guys in episode 19. Start trading now on Mosey Finance. Trade perps everywhere with one dashboard. Link in bio.